Hey option traders, for today's trade, we're looking at a bullish option play in Dow Jones leader and iPhone maker Apple. With many growth stocks tumbling over recent weeks, it's important to look for strong stocks when trying to find bullish option trades. Apple is one that's still holding up reasonably well despite broad market weakness. The stock ranks first in its industry group and has a composite rating of 89. Crucial support lies between 150 and 152.50. The stock has clearly fallen in recent weeks, but is gaining support at its 200-day line. This indicates potential bullishness. Additionally, on April 28th, the company reported record revenue of $97.3 billion, an increase of 9% year over year. This beat expectations for revenue of $95.5 billion. EPS also rose 9% year over year to $1.52 a share. Ideally, you want to see the stock above its 50-day line before buying long. But if you want to get long while the stock is still below this level of support, you could consider putting on a risk-defined strategy known as a bull put spread. A bull put spread is an excellent strategy for beginners and is used when investors expect a modest rise in the underlying stock price. For this trade, we expect Apple stock to go up between now and the option's expiration. A bull put spread involves buying a put option on a stock and selling another put option with a higher strike price. This forms a range between the two different strike prices. The investor can expect a profit or a loss based on where Apple stock finishes within that range upon the option's expiration date. The investor nets a credit for putting on this trade, meaning you are paid a premium upfront. Since puts lose value as the underlying stock increases, both options would expire worthless if the underlying price finishes higher than the highest strike price. Here, the maximum profit would be achieved and it would be the total premium that you initially received. A drawback to the strategy is that it limits the profit earned if the stock rises well above the upper strike price. However, on the downside, if the stock price falls below the lower strike put option, the purchase put, both put options would have lost money and the maximum loss for the strategy would be realized. The maximum loss is equal to the difference between the strike prices and the net credit received. Let's talk about a couple simple rules for taking profits. First, if the trade has achieved a profit equal to 50% of the premium received, then that can be a great time to take profits and move on to the next opportunity. This is particularly true if the profit comes in the first half of the trade. On the other hand, when a bull put spread moves against you, don't allow the loss to get bigger than 1.5 to 2 times the premium received. A second rule to consider is rolling a losing trade out in time to the next expiration. The next expiration could be a weekly or a monthly option. The main thing to remember is you only want to roll for a credit. Rolling out in time means you are tying up more precious capital for another week or even a month. So it's essential to receive a net credit for that extra risk being taken. The final and most important rule for managing bull put spreads is never let the stock break down through the short put strike. If this happens, the trade becomes very hard to adjust and leaves your account exposed to potential assignment risk. We often look at bullish trades with around 1 or 2 months in duration, which is in line with today's trade. But as a side note, some traders prefer trading shorter-term options, which expire sooner. These have the potential to generate higher gains on an annualized basis. Let's take a look at my trading platform and set up a trade with a June expiration. So here we are on my trading dashboard. We have AAPL pulled up. We are looking at a vertical spread type. We've got our strike prices down here in the middle panel. And we're going to be looking at this pair right here, 145, 150. Make sure you're on this side of the screen, which has the prices for put options. And down here, I have the trade set up and ready to go. We are looking to sell one June 17th, 150 put and buy one June 17th, 145 put. We're looking at selling the June 17th, 150, 145 put spread to create a bull put spread. Selling these two options generates roughly $120 in premium. The capital at risk on the trade would be $380, so the trade has a potential to generate a 31.6% return in 44 days, or 262% annualized. But if the trader instead decided to trade a much shorter term spread, they could generate around $65 in premium for selling the May 13th 150-145 spread. The spread can make around $65 on risk of $435 for a potential return of 15%. That's slightly lower than the first example, but this only takes 10 days to achieve that return if the trade works out. That equates to a roughly 545% return on an annualized basis. But shorter term options also come with downsides. When they go against you, there is very little that you can do to salvage the trade, whereas a spread with an expiration that's further out gives you more opportunity to manage the trade if it turns against you. As always, remember that if you're new to options, make sure you practice with a virtual trading account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.